So everybody wants to know about PayPal, Facebook. Let me give you some detailed analysis on this and where I think things might go. All investing is risky and there's no guarantee of what I'm saying is going to transpire. This is PayPal to begin with. There's more detail on the links in the bio, you'll notice. Okay, so share price at the time of writing is roughly at about $124. I've marked 1, 2, 3, 4, which are potential scenarios, and I've tried to assign some probabilities on this. Now, what's happened is expectations have got so high at long last with technology companies that those companies are finding it very difficult to match those expectations, whether it's expectations on user numbers or on revenues or on profitability. So even companies which are hugely profitable, throwing up tons of cash, are giving excuses for the market to punish them because those expectations have become so high, which is another way of saying that the market's scared. Okay, it's not that it's over optimistic and that's why expectations are high and it intends everybody to do incredibly well. At the moment, you just need to look around to know the market's more fear driven than driven by over optimism or over exuberance. It's not an exuberant market right now. It was a few months ago. So all of that being the case, and don't forget, with the data you get in accounts, you'll always find dirt. Okay, so your company might blow your expectations on profits, on sales, but it misses by 0.1% on users. Boom. Somebody decides to sell it, everybody else panics, and you get a sharp fall. So once you get past the point that you think the company is fundamentally sound, you strategically want to be in it, it's got great numbers, it's an exceptional company. Once you get past all of that, then you've got to ask yourself, okay, well, what are the outcomes of where it might go? Now, point one, I think that I've marked in red, I think we're already there anyway, so there's only, it's not going to stop there at where we are. Will it fall to point two? I think, yeah, that's pretty likely. 25% probability I've assigned. I think most likely is it'll go to point three. And the reason I marked point three is it's been a support level in the past, going as far as 2018, that others will be mindful of it. I don't think it's likely to go as low as 0.4, but if it did, I'd be definitely filling my boots, because we're then talking about it going back to 2016 levels. Losing 5 years worth of gain, and I think that's improbable, but I've assigned it a 20% probability in case the market overshoots to the downside. My basic point being, what I'm looking at is I think there's a 100% return from current price levels, within the 2 years. Now, if it drops as low as $40, then obviously that's far more than 100% return. So I'm talking about from current levels at 124, I think it gets to 250 again within 2 years. That's 100% return. Now, if it falls further and you buy more, and I'd be attracted to buy more if it falls further, because I'm looking at that $250 price target within 2 years. So that's enough on that one. Let's therefore have a look at Meta platforms. Okay, now it's already hit 0.1, pretty much 0.1 on there. So is number two likely? Yeah, that takes it back to 2016 levels. 2016 levels. That's a buy to me, because once you agree, fundamentally it's a sound company producing a lot of profits. Yes, some users went to TikTok, gee whiz, and I agree, old people are more likely to be using this than young people, but I know that myself, being young, obviously shifting to TikTok as I have, and my parents are still on Facebook, but guess who's got the money? It's not the kids on TikTok. The people who've got the money are the ones who are on Facebook. Anyway, there's a whole load of reasons to assume that it's not about to go bankrupt anytime soon. So where do we end up? Well, point two, I think from current price levels, we get to $400 within 2 years. That from current price levels at the time of recording gives us about a 75% return. If it falls further, then that might give us a 100% return if it gets to $400. So if it drops to say 200 within the next 2 years. Okay. So that's where we are on that. There's a couple of interesting things with this that I want to talk about, which is with Meta, which is this. And I said, as long as you think fundamentally it's a sound company in terms of profitability, net asset value, free cash flow, earnings, projections, forecasts for turnover. There's nothing worrying about, debt levels. Obviously, the company's just loaded with cash. The amount of cash return it gets on capital it invests, return on equity, anyway, all of those green. But I tell you what's interesting, and this is one for the index tracking people. Since 2017, so over the last 5 years, it's just matched the S&P. Now, thanks to the most recent falls. Most of the time it beat it, which was the argument for not using an S&P index tracker. Now suddenly there's an argument that you could have just had a smoother run by having an index tracker of the S&P. So those who say don't stop pick and just use an index tracker, that's their case made for them right there. Okay, hopefully you found that interesting and of some insight and use. Have a look at my Telegram channels. The links are in the bios and around the website. And if you can't find it, just go to campaignforamillion.com. Campaignforamillion.com, which is my campaign to teach a million people how to be better investors. Thank you very much.